Brad Williams, Frugal Finance, Introduction to Present and Future Value. This title will be used a couple different times. Don't worry about it. In this part, we're talking about money changes value over time and how it affects investment decisions. Let's break it down with an example. Imagine a company buys a machine for 30 grand, uses it for 5 years and sells it for 6 grand. During those 5 years, they spend money on maintenance. $8,000 the first year, $9,000 the second year, $10,000 the third year, $11,000, $12,000, and so on. The company calculates everything using a 15% interest rate. Now, they want to know two things. How much money at the start, year 0, year 5 would be equal to all the money they spent and earned with the machine? What's the consistent amount of money they would need every year for 5 years that equals the machine's overall financial picture? In finance, the beginning value is called the present value, noted as PV. For this example, it's calculated as negative 30 grand, the initial cost, minus 8,000, the first year's maintenance, divided by the interest rate, 15%, plus 6 grand, the salvage value or the selling price, minus $1,000, the yearly maintenance increase, times a certain calculation. The total is 59,609.57. The ending value, called future value, is noted as FV, is also calculated. So FV, and we're going to look at, I don't like this particular format. This is old school engineering. And for you engineers, I say thumbs up, but it doesn't work for me. I'm a finance guy and I'm not association F&P and whatever. I'm going to go down here. And I included what I think are more appropriate and easier to follow equations. So we have a net present value. We're going to have this future value. We're going to have this payment. I'm going to use my equations. And with this being said, I'll continue reading what this is. But here, the ending value, called future value, is noted as FV, is also calculated at 190. The 5-year cost is without interest, is 74,000. This is the cash flow of the machine. 119, annual worth, the annual cost each year of this machine, 17,839. And here's the net present value. What are we doing? A uniform series equivalent for a series of yearly cash flows is referred to as the annual worth or the equivalent uniform annual cost for the project. The latter expression is most appropriate for the type of example under consideration, since the resulting uniform series is a cost, not an income series. The annual worth designation is AW. EUAC denotes the equivalent, here we go, the equivalent uniform annual cost. So our annual cost is going to be, this is what it's going to cost us, taking into consideration our 30 grand interest maintenance. Got that? And I think we take into consideration the net. What's the net? Because we're going to get 6 grand when we salvage this thing. The bottom line is this is going to be 17 grand a year. Can you just multiply that times 6? Go ahead and try it. Let's get into the meat and potatoes here. Here's our starting point, 15%. Whatever we're buying, it's 30 grand. Our maintenance is 8 grand. These are fixed numbers. You're going to have to put this stuff in. So I'm going to designate them as yellow along with this rate. As I said, it's going to be 8, 9, 10, 11 grand. And then I took the 12 grand plus the 6 grand. So the 12 grand would be maintenance for year 5. Then we're going to sell this thing. The net present value is really simple, really simple. We're going to look at net present value. Here's the 15%. C52, that means this number right here, project purchase, C52. We're going to just discount this information. Got that? We got 59,609 is our net present value. What does that mean? That means we have to look to see if, in comparison to either leasing or buying or renting this machine, does it pencil out? This is just a static number. You have to use some metric, or you ask yourself, if we buy this thing, what impact will it have towards our future sales? Will it increase our sales? Then you have to do a comparison. And then the present value here, this is just the present value formula. What we're doing is we're taking this 30 grand. We're going to divide it by 1 plus 0.15. Then we have a time. We're going to have 30 grand. We need to discount C53, which is 8 grand. Divide this 1 plus C. See the number here? That's all screwed up. There's no 1658. That number is old. It should be C51. Okay, that makes a lot more sense. This net present value, if you stumble, if you get caught up in the weeds here, and I use that expression all the time, you can do this manually. In other words, you're going to take this simple present value formula, and you're just going to discount it based on time. All we're doing is taking this number right here, dividing it by 15. Then you have to take in the time consideration. And in the end, it reconciles. All we did was discount this to the 59,609. And then this number is going to be the opposite. Well, wait a second. Again, if we want to know this number here, we have this future value, 15.5. We're going to take the present value. All we're going to do is use this 15%. So we'll take D58, then 1 plus 0.15, and we're going to get 119,896. So the first question is, how much money at the start and end would be equal to all the money? Here's an annual expenditure of 17,782 divided by years for 5 years is equivalent to the cash flow profile associated with the machine investment. Alternatively, the EUC cost, the equivalent uniform cost, can be obtained from either the present value or future value. Present value, future value, and annual worth computations are used often in comparing economic analysis, etc., etc. So in the end, we've got this cost. That's our net present value. And all we're doing is a breakdown of this thing, taking into account the 5-year cost. If you break all of this down, our annual cost would be 17,839. Keep in mind, if you divide this 119 by 5, it's going to show 23 grand. That's not equivalent. You have to take in consideration the compounding effect. Brad Williams, Frugal Finance. Thanks for watching.